Hello everyone and welcome to this video. In this particular video, we are going to look at a very important topic. This is an extension to a recent video which I had just done on fundamental analysis, and we are going to look at the limitations of fundamental analysis. What are the risks that are involved when we are using fundamental analysis, and basically how do we overcome those risks? What you need to do to make sure that limitations of fundamental analysis don't affect you and you basically make informed investment decisions. So, a quick preview as to what we will cover. I'm going to list out six critical limitations that fundamental analysis can create if it is not done properly. So, these limitations can basically throw you totally off your game. You're trying to make money by buying low and selling high, but if you don't pay enough attention, then what's going to happen is that these mistakes are going to creep in, and eventually you'll realize that you did everything correct, but then the returns were not as expected and your investments did not turn out to be profitable. So it's very, very important for people who use fundamental analysis to understand the risks. So we're going to look at all the risks, all the limitations of fundamental analysis, and then as it's mentioned here, we are going to look at the professional approach as to how to overcome the limitations and reduce our risk. So without further delay, let's get started. Before we proceed, a quick look at the disclaimer as usual. Whatever information I'm sharing with you is only for entertainment purposes. It is not any kind of trading or investment advice. If you plan to invest or trade, please get in touch with your financial advisor and don't consider any of my inputs in this video as any kind of trading or investment recommendations. So the first limitation is accuracy of the data. Now, I have created separate videos on basically what is fundamental analysis, how it differs from technical analysis. So, if you don't know what fundamental analysis is all about or what the overall world of analyzing stocks looks like, I'll leave a link in the description to those videos so you can watch them there. I even have a video which gives in detail the Finviz screener for identifying stocks which are trading at a discount, the undervalued companies using fundamental analysis. So I'll leave those links in the description, but in this particular video, we are going to focus on the accuracy of the data, which is the first problem. So for those of you who are familiar with fundamental analysis requires us to pick up the various financial statements and the filings that the companies do with the SEC. So you pick up the balance sheet, you pick up the P&L statement, you pick up the cash flow statement, the 10K filings, and all other documents which are there, and then we try to make sense of those numbers. But the thing is, who is generating these financial statements? These financial statements are being generated by the companies themselves. And when I say the company, ideally I should say the top executives of the company, the management of the company. So what is there in this scenario is that all companies want to do well. They basically want to show the best possible numbers for their top lines and bottom lines because that really affects their reputation in the market. And what happens in most of the companies is that these top executives who actually end up signing off on these financial statements, a major portion of their salaries is in the form of incentives, which depend on the performance of the company. So, if the company does well, their incentives are really high. If the company does not do well, then they don't get paid out those incentives, or those incentives reduce considerably. Moreover, in extreme situations with public companies, because the management is running a company that's owned by the shareholders, if the same management is not able to deliver results year on year, then the shareholders can decide, the board of directors can decide to actually change people on the management, so people can get fired as well. So I'm not saying that the CEOs or the CFOs of the companies are fudging the data, and I'm not suggesting that, but I'm giving a general idea that people who produce these financial statements are the ones who are managing the company, and they have a lot of incentive to make their numbers look good. So, three things can basically happen here. One thing is that the company is definitely reporting genuine numbers. There's nothing wrong with the numbers, but they are reporting good numbers because they're genuinely doing well, right? So in those cases, there is no foul play. There is no information which is being hidden. All the risks are being called out, but the company is eventually doing well. So it's all a win-win situation, both for the management and the investors, because there's nothing to hide. There's no reason to hide anything. The second situation which is there, which is possibly there, is where the company is not reporting anything which is wrong or false. That means they are within the legal bounds. But the accounting practices are such that a lot of flexibility is available for companies in the way they report their numbers. So now there is a lot of standardization with gap and other rules being there, but still in accounting practices there is a lot of flexibility that the companies have in the way they can report numbers. So numbers to a certain extent can be modified to increase the top line or increase the bottom lines, and that may or may not represent a very clear picture to the investors. In some cases you can have a very complex accounting system, so an average investor, when they try to look at the balance sheet or the P&L statement, they may not be even able to understand all the numbers there and make sense of it. So when you don't understand something, you're not going to be doubting it. So that's the second case. And then the third case is where the numbers are being uh, falsely reported. Obviously this is not allowed, but by the time these kind of mistakes are caught, these frauds are caught, it's a long time, and by that time, like maybe 4 or 5 years have passed since the company has been reporting wrong numbers. And what will happen in those cases is that all of a sudden the stock price will plummet, so all your analysis basically goes out of the window. So this is the first major limitation with fundamental analysis, that you're relying on data which is coming from the companies themselves. If you look at technical analysis in parallel to fundamental analysis, all you're relying on is the price and volume data that's coming from the stock exchange, and that data cannot be falsified. Whatever price, whatever trading volume is there, the same is going to be reported by the exchange. The exchange is a neutral third party. They have no incentive on hiding this kind of data or fudging this data for any company, because they are not directly associated with any of the companies. But when it comes to fundamental analysis, the basic documents, the basic reports that we analyze, those reports are generated internally by the company. And so there are chances that that data is either not accurate, or if the data is even accurate, it is represented in such a complex form because there's something happening behind the scenes, and an average investor will not be able to catch those tiny details and basically understand the fine print. So, having said that, is fundamental analysis a waste of time? No, absolutely not. But we have to be cautious that this is one problem which is a limitation of the fundamental analysis. And let's now see how we can fix this problem, or how we can reduce the risk that this kind of a problem basically introduces. So the first thing is, you should have a high margin of safety. And what do I mean by margin of safety is that if you feel that the stock is trading at $100 and the intrinsic value of the stock is $120, wait in investing in that kind of a company. The reason is you just have a $20 cushion. If your estimates are wrong, or more importantly, if the details that are being furnished by the company are incorrect, then that valuation that you came up with of $100 can, I mean, $120, that can turn out to be $80 in no time, right? So you want to have a sufficient cushion. So I would suggest that if you're planning to invest in a company which is right now trading at $100, make sure that the intrinsic value calculation that you end up arriving at is at least a 180 or $200. So you're buying a company at least at a 50% discount, maybe a 40% discount, because in today's world, the markets are really bullish. There are a lot of investment people coming in through apps like Robinhood, and there's a lot of buying pressure. So in general, it's very difficult to find companies which are trading at a 50% discount. So even at a 40% discount is good. What's this going to do is, your calculation, let's say, of intrinsic value, you calculated $200. The stock is trading at $100. Even if the company comes out and says, there was something wrong with our numbers, or some analyst or some researcher later finds that these numbers don't really make sense, they're not as good as the company has been projecting them, the stock can take a 30% dive. If the stock intrinsic value of the stock takes a 30% dive from 200, it will become 140. So the new calculation is the company is actually worth $140. But since you bought into that company at $100, you still have a $40 profit making ability. And the more important thing is that you're not going to be taking losses. So margin of safety is very, very important. This is one key factor which legendary investors like Warren Buffett, Charlie Munger, and others, they have been advocating. This margin of safety is really, really, really important. Always remember that your own calculations in fundamental analysis, your own estimates can be incorrect. Moreover, the data being provided to you, as I've explained, in terms of the financial statements may be inaccurate. So margin of safety will keep you safe. It is going to give you that extra cushion to be wrong or to be working with wrong data. The second thing is you need to build a portfolio. Now I have a separate video where I explain what a portfolio is, how is it managed, and what's the importance of building a portfolio, why all professional managers basically work with a portfolio. So I'll leave a link to that. You can watch that in more detail. But for now, understand that when I say portfolio, I basically don't want you to concentrate risk in one or two stocks or even in one or two sectors. That the reason behind that is that if you do that, let's say you just go all in into one company and there's something wrong with that company, the results that the company has been reporting are because they have been reporting incorrect figures. That company is going to go bust and you will lose all of your investment. We don't want to be in that situation. Consider companies like Lehman Brothers, Enron. These companies were the top rated companies in the world before they declared bankruptcies. So understand that no company is barred from this particular rule, that whatever looks very very lucrative today can all of a sudden turn out to be into the worst investment possible, because we are not producing the financial statements, we are not generating these documents, and so if these documents are not being correctly reported, there is no way for us to know. So we need to be prepared as investors against this eventuality, and the best way to do that is to build a portfolio. You can watch my video on portfolio management, which will basically tell you how to create a balanced portfolio where you neither over diversify and take mediocre returns, nor you have a concentration of risk. So that video in detail will tell you how to build a balanced portfolio and what all you need to do to adjust the portfolio. It has a lot of details and it will be very, very useful for people looking to use fundamental analysis. Now let's get to the second limitation, which is turnaround time. Now, what do I mean by turnaround time? Usually, when we make an investment, we expect returns. In fundamental analysis, we are trying to buy undervalued companies. The undervalued companies exist because we, by our analysis, feel that the company should be worth much more, but the overall market has not understood that. So our expectation is that in due course of time, the overall market will align with our analysis. Coming back to the example that I used earlier, let's say a company is trading at $100 and we feel that the intrinsic value is $200. So the expectation is that we feel the assets, the cash flows of the company, the way it's generating and the growth prospects, they allow the company to be valued at $200. But the overall market consensus is that the company is worth $100. That is why it's trading in the stock exchange at a price of $100 today. So our expectation is that eventually, over a period of time, the market is going to realize that it's pricing this particular share incorrectly and the share price would increase to $200, thereby giving us a handsome profit. But this understanding of the correct valuation of the share price can happen within a week, it may happen in 5 years, it may happen in 10 years. We cannot force the market, or we cannot estimate the time frame within which the market is going to understand and correct its valuation of the company. So these investments are usually long term, and in the long term, these investments are bound to give you good results. But what happens is when you make an investment and you don't see any growth, you don't see any returns for 2, 3, 4, 5 years, it becomes really, really difficult to hold on to those investments because we start doubting our analysis. And this is not specific to any person. Try investing your money into something that you've analyzed in the best possible way and you had absolute conviction about, but as soon as you start losing money or as soon as you start seeing that for months together you're not getting any returns, you will start doubting your analysis. And this is basically human psychology. So the first thing is you need to develop your trading psychology and the investing psychology to know that you're correct and you're going to be correct in due course of time, and you need to give the investments enough time to play out the way you expect them to play out. But one way to overcome this limitation, that you don't want to wait for 5 years or 10 years to see your investments give you the results that you expect, is to basically invest in stocks that pay dividends. So what happens is you don't get the growth on the stocks probably. So your $100 stock may not become a $200 stock for the next 5 years, but if it's paying a yearly dividend of 4%, then you're making some returns. So if you have people in your family questioning you, why did you put money here? It's not giving any returns. So and so friend is making huge returns on so and so other stock. You at least have something to calm them down and tell them, no, this is a multi-bagger opportunity, and more or less we are getting a 4% or a 5% dividend yield, which is better than nothing. So invest in stocks if you don't have that strong trading psychology, or if you really need money, some kind of cash flow, maybe small amount to meet your monthly expenses, then you can look for stocks which pay out dividends. Now, when you're selecting stocks that pay out dividends, I have separate videos. You can check my dividend playlist. I have discussed about a screener which helps you identify good dividend stocks. I leave a link to that as well in the description. But the thing is, don't become over ambitious in terms of dividends. Don't try to get all the returns from dividends. Don't look for stocks that are giving you more than 10% dividends. You still need to invest in fundamentally good companies. So the fundamental analysis doesn't change. The only difference is if you have five options, instead of selecting a company which doesn't pay any dividends at all, which is a purely growth stock, you go in for a company that pays some dividends as well, so that while your investment thesis works out and it basically rolls out the way you expect it to roll out, you're not left just watching your investment. You get some returns, which gives you that peace of mind that your investment is not totally not working. And you can basically hold on to your investment. Your trading psychology is much better when you have some returns coming out of your investment. The second thing that you can do is that you can basically use the covered call strategy. So in covered calls, let's say I bought the stock when it's trading at $100. What I can do is I can sell the 120, 130 calls, because obviously I expect the price to go to $200 over a period of next 3 to 4 years, maybe next 2 years, maybe next 1 year. I don't expect that to happen in a month. So I can go out and I can sell the monthly calls at 120, $130. And what that will do is those calls will give me some premium. So that's kind of a monthly cash flow that I'm generating. And those returns can compensate some of the wait time, some of the anxiety that you have, whether your investment's going to work out or not. And the longer your investment takes to work out, the better it is to use the covered call strategy, because then you're working with a stock that's not too volatile. And this will really help your trading psychology. You, instead of being anxious that you're not getting any returns, you'll be getting a monthly paycheck. It'll be small, it could be big depending on how volatile the stock is and where the options are trading, but you can collect that paycheck. And in the worst possible scenario, if the stock prices shoots up and you basically end up selling your stock, the calls get exercised. Let's say you sold the 130 calls on a stock that you bought at $100, and for some reason the stock just shot up, then you end up selling the stock, your shares, at 130 bucks. You keep the premium, and along with that you get the $30 per share return, which is a 30% return. So not bad. But then these are the two ways: investing into stocks that pay dividends and executing the covered call strategy, which will give you a much better time if you're the kind of person who doesn't have patience, who doesn't have the stomach to hold on to their investments and believe in their investment thesis for a long time. Because people who manage money professionally, they know that eventually the stocks will work out the way they expect them to work out, but everybody doesn't have that kind of a strong mental setup. So turnaround time is another problem. It's a limitation. These fundamental analysis is only for long term, and therefore if you need regular returns, these are the two ways you can basically get that done. The third major limitation with fundamental analysis is wrong assumptions. So if you've done any kind of fundamental analysis, the first part is identifying good companies which are kind of undervalued, and then you want to come up with an exact intrinsic valuation of the company. Now, while doing that intrinsic value calculation, you have to basically assume a lot of factors. What is going to be the future's earnings growth rate, the sales growth rate, what's going to be the future P2E, what's going to be the discount rate, and that's based on the interest rates that will exist in the future. So you're making a lot of assumptions with regards to these numbers. And what can happen is, for example, nobody knew that the pandemic is going to come in, and now we are seeing a lot of inflation coming in. So the discount rate all of a sudden went up, and all the stocks which depend to a large extent on future earnings, like tech stocks, like companies which are really getting started, they took a big dip in their prices some months back because of the increase in the inflation. So rates were expected to go up, the discount rate simply just goes up, and then the valuations of these stocks starts coming down. So besides the first limitation that we discussed, where the financial reports may be inaccurate, your own analysis, where you're making assumptions on these numbers of growth percentages and the discount rates, you can be incorrect because the macroeconomic conditions may change, and those changes may be unexpected, which you can't anticipate right now. So again, for that, the way out is that you need to keep a lot of margin of safety. Margin of safety, as I've explained earlier, will give you that cushion so that even if you're wrong, your valuation, your value, the intrinsic value was $200 for you. Even if it turns out to be 130, you still are not going to take a loss, and that's very important. The fourth limitation is market risk. So macro changes in the economy, in the way countries operate, the governments operate, they can change the investing environment in no time. Pandemic was a perfect example. Nobody knew before 2019 that we are going to see the coronavirus pandemic, and it's gonna the way it's gonna affect the overall markets and which companies will get affected, and companies which look really lucrative, some companies which were cash cows are almost on the uh, they are about to file bankruptcies. So this particular macroeconomic condition can change anytime, and so we need to plan for those things as well. So how do you basically take care of macroeconomic conditions which nobody can control? There could be a world war, there could be a pandemic, there could be a financial collapse, there could be something else going wrong in the economy. So how do you plan for these things? The first thing is you need to invest in companies which are basically resilient to different market conditions. So think about this particular pandemic situation. Okay, there were there was a lot of jobs were lost, so people did not have money. But let's say somebody is doesn't have a salary and they have some savings. What is that stuff that the last dollar would be spent on by a household, which basically doesn't have too much of an income? Those would be food, the basic staples, and water and electricity. So the first two examples that I've given here, companies in the utility sector and companies which provide staples like the bath rolls, like soaps, these are the companies which will continue to exist forever in any market conditions. Because the first thing is you need to have electricity, you need water. So even if you have less and less money, what you'll stop doing is you'll stop buying expensive products, but you will definitely continue paying for these basic services, right? So if you're invested into companies which obviously as per fundamental analysis also are trading at a discount, they are undervalued, but they belong to the utility sector or they are into providing staples, then you're pretty safe. The same thing holds for companies which work with royalties. Now, the royalty part, consider a company which is just collecting royalties like Universal Music. Now, all they do is they have music which is being sold all across the world. Whenever somebody listens to a song on any of the subscription services, whether that's Spotify, whether that is Apple Music, or any other service, they get a certain amount of royalty. It's very small, but consider the number of songs being listened to across all platforms across the globe, and that really adds up to a huge number. So they just keep receiving these royalties. So any businesses which are earning a lot of money in terms of royalties for the patents that they are allowing others to use, for music as I gave you the example, or for streaming services, wherever whoever is creating royalties, they basically are running a business which is having a huge amount of cash flow with almost zero investment, right? So those kind of businesses will do extremely well in these kind of financial crisis or pandemic situations, because they don't need any other business. I mean, they don't have to really run the business. There are other companies that are running the business, and as long as the other companies exist, those that market exists with any of the specific companies, it doesn't matter whether it's Apple Music, it doesn't matter whether it's Spotify, it doesn't matter which platform is finally providing music to the listeners. These companies are going to simply receive the royalties. So if you are invested into these resilient kind of companies, then you basically take care of the market risk to a large extent. You're not going to be losing money if there is a market crash, if there is some kind of a financial crisis or some kind of a macroeconomic meltdown, you are still pretty safe. The fifth limitation of fundamental analysis is that requires a certain level of expertise. First thing is the information that is contained on the financial statements, they use a lot of accounting terms. So you have to be well versed to understand What is earnings before taxes? What is depreciation? How does depreciation play out? How does it affect the P&L statement? How does it affect the balance sheet? So you've got to really understand these concepts, and everybody doesn't have a finance background, so chances are that you may not understand these terms. Good news is it takes a bit of a time and effort to understand these terms, but this is not rocket science. It's not something that an average person cannot do. If you can understand and manage your own bank accounts and manage your expenses, you can very well understand the balance sheet, because the balance sheet or the P&L statement is nothing but just a salary and an expense statement for the company, right? So you receive your salary and then you make your expenses. If you can understand this, then you can understand the P&L also, because in the P&L also the company is generating a source of income for itself through sales, and then they're making certain expenses which are cost for making those sales or creating the product that they're finally selling. So if you look at it and you spend some time, you will basically be able to understand the basics so that you can read and understand these financial statements. Basically, you should be in a position to read through the statements and make sense of it. I don't expect people to become accountants overnight, but then you should have the basic knowledge to understand the financial statements of a company and understand the technical jargon, that the basic people talking about stocks and investments, that basic terminology glossary you should know, which doesn't take too much of effort. If you put in the focus effort, you can do that. The second thing is valuation. Valuation becomes a bit more complex because you need to make a lot of estimates. Like I mentioned in the previous slide as well, you need to estimate the growth rates, you need to estimate the discount rates, which can be slightly complicated at times. But again, uh, you don't have to be an expert there. Okay, you don't really have to be an expert there, and there are a lot of resources out there which will provide you free valuation figures, so you can look at 3 or 4 sources online and pick up their valuations and average it out in the beginning, and then you can start doing your own valuation and see if you're getting close to those numbers. So you can just google what's the valuation, intrinsic value of so and so company. You come up with 3 or 4 numbers on 3 or 4 websites, and then you try to slowly learn how to arrive at those numbers. So that is all good, but the most important thing is that we can get all this information ready made on platforms like Finviz. So I have a video, as I mentioned earlier, which is the Finviz screener for fundamental analysis. So it gives you, based on the fundamentals of a company, which are the best companies to invest in right now, and those companies get listed in the output. So one important thing that I discuss even in that video, because even with fundamental analysis you can look at hundreds of ratios. Okay, people have constructed those ratios over a period of time, but what I suggest to my viewers always is that keep the analysis as simple as possible. You do not want to overcomplicate things, especially you do not want to look at data which you don't understand. I don't want to look at a ratio which I don't understand, which I don't have a deep understanding of how it is calculated, first of all, and it being high or low, how does it really impact my analysis? Is it a bad company? Is it a good company? What does it reflect? So, unless you understand something, don't use it in your analysis. Keep your analysis very, very simple. And if you look at my fundamental analysis video, I'm talking about only a couple of ratios, 3 or 4 ratios, which basically ensure that the business is giving good returns, which basically ensures that business has good growth prospects, and they basically make sure that there is no chance for the business to go into bankruptcy. And the final fourth thing is that the business is trading at a discount. So these are the 4 things that I look at. If you have these 4 basics right, you don't really have to look at how well the inventory is being used and how other things are being used. Obviously that additional information helps, but that makes things overcomplicated as well. So avoid analysis paralysis, which basically means you're trying to use too much of information, you're trying to make too much of analysis. Over analysis is very, very bad. Do your analysis correctly, do your analysis on things that you really understand, and do your analysis to that minimum threshold level so that you end up selecting good companies. As long as you can do that, you're going to be fine. No investment analyst, the professionals who are sitting in investment banks, they also get it wrong. So what's the point of spending 20, 30 times the effort and spending that kind of money when your accuracy rate is pretty much the same? So I showed in my video that I was getting about 85% accuracy as compared to the analysts. So the analysts, if they picked 100 stocks saying that these are good stocks based on fundamental analysis, then I was picking 85 to 86 of them as well. So my point is that my recommendations, I can get 85% of the similar results that professional analysts are getting without putting in that kind of effort. And also, the analysts are not 100% correct. So there is no reason to believe that the 15 stocks additionally that analysts are suggesting that I did not get on my shortlist, they are actually good companies. They may actually not work because analysts also work with a probability and they have a rate of success, which for some of them is very, very low. So the point I'm trying to put across is do not overcomplicate your analysis. Work with simple things, and if you work with simple things, then this the expertise that is required, it comes down to a level which almost everybody who can manage their own bank accounts, their salaries and expenses, they will be able to handle this analysis. The sixth limitation here is that fundamental analysis is only usable for long-term time frames. And I've mentioned this before that the valuation of a company has to be corrected by the market. So market feels that the company is worth $100. You and your intrinsic calculations show that the company is worth $200. This correction in the perception of the market may take a long time to happen, and you can't basically use fundamental analysis for taking weekly trades, because in weekly trades that perception is in a week's time is probably not going to change. So again, the solution is pretty much similar to the solution that I have given for one of the points earlier, which is that invest in stocks that pay dividends and carry out a covered call strategy. Because what will happen is if you have to hold on to your investments for a long time, you at least start getting some returns during that time. So first thing, it boosts your overall rate of return, and secondly, it keeps you in the right mindset. You don't feel that your investment is going nowhere and you just invested and you're sitting on that pile of cash for months and years together. So I hope people who are trying to use fundamental analysis really watch this video and take this seriously, because when you're trying to use any tool, the most important thing is to understand the precautions that you need to use when using that tool. Fundamental analysis is really powerful, value investing is really, really powerful, but at the same time you need to understand what the limitations of fundamental analysis are. If you understand the limitations of fundamental analysis, then you can take these corrective actions. Because if you look at this video, people will call out these limitations, but nobody will give you the solution how you can basically formulate your trading strategy to overcome these problems. So I've tried to explain that, and hopefully this video will help you in improving your fundamental analysis and also manage your investments. Once you take a position into a company, you will better manage your investments over a period of time. So if you like this video, please like the video, subscribe to the channel, and share this with your family and friends if you find this useful. And I'll catch you guys in the next video. Thank you.